Okay, this is part 2 of number 33. So the first part where we actually translated these financial statements is all done in a YouTube video. So please watch that so you understand. Really the key to that one is which translation rates do you use where. So anytime we're dealing with the income statement, we use the average rate. When it's a specific thing like the dividends, there's going to be a dividend rate. Then when we get to our balance sheet, we use the end of the year rate except for specific items, which is our common stock and our paid-in capital. They're always going to provide us what the beginning of the year retained earnings is and the beginning of the year, the end of the year cumulative. They'll give us the beginning of the year cumulative translation adjustment, and then we'll see how we kind of back into what the current year was. Now this is just a plug. This just is what makes your balance sheet balance. So your assets equal your liabilities. But again, look at the YouTube video for the computations of that. Then now we're going to pick up to say, okay, and the same with the statement of cash flows. Then we're going to pick up with the second part of it that says, okay, now we need to consolidate these financial statements. So this first little section here shows, okay, if my cumulative translation adjustment account, my plug number is this number here, $820,951. That would mean that that's my ending balance. So that's where it ended. Now, if you go back to the problem, they tell us that our beginning of the year cumulative translation adjustment is $183,768. So this one they give to us. So then we can just back into what the current year portion is. Now the textbook publishers will go through a whole computation, but I don't really feel like that's necessary. And then it's a lot of extra work and it's kind of confusing. So to me, just stick to this to say, okay, I know what my end of the year is because I needed it to make my balance sheet balance. They provide me the beginning of the year. So the difference is going to be my current year. And again, this isn't really that relevant, but the parent would record that following the equity method of accounting. Okay, then we come into our next common steps that we do for a consolidation entry. So the first one is to reconcile our equity income. So the subs net income after translating is the $415,441. So again, go back up to those translated financial statements, and it is their translated net income after we calculated it at the average exchange rate. So that's where that number comes from. Now then this we have to calculate. The textbook told us that they have a patent that they are advertising, and it was initially valued at 300,000 Brazilian reals. They're amortizing it at 30,000 Brazilian reals a year. Again, that's in the foreign currency though. So now when we go to adjust it, this is already adjusted. We also need to adjust the amortization. So if we take the 30,000 Brazilian reals and we multiply that by our exchange rate, the average rate is 51 cents. That gives us $15,300. So we subtract those out, and that gives us our equity income of $400,141. And then again, that would be what we're tying out to on our statements. So if we were to look over at the parents' statement that they provide us, that is what they show as their equity income, and we double check it and it's correct, so we're good. Then if we look at the parents' balance sheet, they show that there is an equity investment of $2,793,352. And then now we want to reconcile that out. Okay. So then what we're going to do there is we're going to take our regular entries that we always do, and we're going to go through our accounts. But again, we have to go back up here, look at those translated numbers. So make sure you're going back to the translated numbers. But then here we're going to pick up our common stock, our paid-in capital, and then our beginning of the year retained earnings that was given to us. So again, those are the three same numbers we always do. So that is our common stock, paid in capital, beginning of the year retained earnings. Now, the one thing that we do add to the E entry is our beginning of the year cumulative translation adjustment. So again, that was given to us in the problem, but it's this 183,768. So that now becomes a part of our E entry. Then we total those up. Then the same with our C entry. We do it the same as we always done. We take our equity income, we're going to eliminate that. Our translated dividends, so again, if you go back up to your statement of retained earnings, those translated dividends are 45,617. So then that is that number. Let me get back down there. So then the only thing though that's added here now is our current year cumulative translation adjustment. So again, we were able to back into that number. We know where it ended on our translated balance sheet. We know where it began because they gave it to us on the problem. So the difference is the current year translation adjustment. So that goes in there. And then we total those up, and that is our C entry. Then our patent, again, this is what you kind of have to map out what's down here below. So this was what makes this one a little bit trickier, is because now we have to look at those acquisition accounting premium assets. So again, it was a patent that was initially valued at 300,000 Brazilian reals. We're amortizing it at 30,000 Brazilian reals. So we kind of mapped this little scenario out. So, and it also told us our beginning of the year balance is the 270,000 Brazilian reals. So those we take and we multiply by our beginning of the year rate. So then this would be the beginning of the year value of our acquisition accounting premium asset, which is that patent. So that is our A entry. So that $113,400 goes up there. Then the D entry, the $15,300, which again is this amortization, that is going to be our D entry. And again, that's normal, except for we have to translate it first. But then here's where the difference comes in. Then we look at it to say, okay, if we just do the simple math of that, that would tell us that our ending of the year balance of the patent is $98,100. But it's not. Because if we come over here and say, okay, but if we're following it in the Brazilian real, after we amortize 30,000 Brazilian reals, our end of the year balance would be 240,000 Brazilian reals. And if we translate that at the end of the year value, our real value of this patent is $136,800. So then there's a difference. And what that difference is related to is just these changes in values. So then now we have an acquisition accounting premium translation gain. So that's this $38,700. And then that is going to also be hung up in the equity investment account because the parent is following equity method accounting. They would record this gain on their books. It would be in the equity investment. So that D entry is part of our consolidating entries. So again, that's a little tricky. So you want to make sure you add this kind of computation when you're doing yours so that you know you have to kind of factor in what happened to that acquisition accounting premium asset. Then we come down to our consolidated financial statements and we put them in just like we always do. So again, the only thing that's different now is this, we have this account, this section here that's after our statement of retained earnings. So the statement of cumulative adjusted, and it goes into comprehensive income, but it's our statement of cumulative adjustments. So then it's broken out though by our beginning year, our current year, and then our ending year. So then we have the two entries that impact it, our E entry and our C entry. So that was our beginning of the year balance. And this was our current year adjustment that we put in. And then you can see as you come over here, it should just equal your parents. So what we should be doing is eliminating all of the sub, and we are doing that. Then we come down to our, again, our C entry is going to be that total that I referenced up above. The E entry is the total that I referenced up above when I was reconciling it. The A is our beginning of the year adjustment for the patent. But then here is that translation gain. So again, that translation gain is going to get hung up in our equity investment, and it's going to be a credit, which will make that zero out. And then again, it's going to be an adjustment. It's going to increase the value of the patent due to the change in the exchange rate. So the debit will go there. Now, if you follow in the textbook, they do break that D entry out and make it a part of this But to me, that's a little bit more difficult. I mean, you get to the same bottom line numbers. It's just they include it in the C instead of having it in a D entry, and then they have an extra entry up in here. So, you get to the same point. I feel like my way is a little more streamlined, and again, you get to the exact same answers. So it's just how you organize the consolidating journal entries. So if you're following me and then trying to trace that back to the book, that'll be just a little bit different. But hopefully my way is a little more streamlined and it makes sense.